The good news is we did have a panel of bankers and investment bankers. The good news is we survived the session. Although I don't know it's because we're actually in Paris today, but the word guillotine was mentioned at least 3 times during the 3-hour discussion. I jest not, by the way. What is good is that there was a definite consensus of opinion that financial institutions do have a real role to play in moving the sustainability agenda forward, and that they need to show leadership. Some people saw that as a radical challenge to the financial institutions, but looking back, it's easy to say that, but why are financial institutions actually important? Basically because they are the key intermediaries within the financial system. I don't think you'll actually find another sector that reaches the parts that other sectors can't reach. We're in the retail market, the wholesale market, commercial banking, funds management, and insurance. So our spread is very long and it's very, very deep. We can influence both upstream and downstream, and particularly through the supplier chain. Like it or not, the financial institutions do actually finance the future. Okay, it's easy to say that. The difficulty is that this has to be seen against a backdrop of acknowledged management, market, and government failure. And there is definitely a policy gap. I think that's come through loud and clear over the last 2 days. The policy signals are not actually aligned to the investment timeframes, and they need to be, particularly in terms of what we're looking at in terms of financing renewable energies and some of the large infrastructure projects that are required in transport, etc. We're also, of course, in the middle, hopefully, or maybe towards the end, of a severe global recession, but that in itself does present opportunities. So the gauntlet, if you like, has been thrown down, but it appears that there are very few institutions that are actually taking the opportunity to pick that gauntlet up. There's a very interesting comment made by Lord Turner, who's the chairman of the Financial Services Authority within the UK. That's the main regulator. And in his summing up of the financial crisis, he made the observation that there had been a lot of financial innovation with very little social value. And I guess that's one of the challenges to the financial sector, which is to take some of that intellectual capital and turn it into social value, turn it towards the environment, and turn it towards the social agenda. As a framework for our discussion, we actually borrowed an acronym from the IT sector, the URL. Okay? But in this case, U was for urgency, R was for relevance, and L was for leadership. Urgency, I think we've all taken as a matter of fact. Something has to happen quickly. Relevance, because there's a lot of investment happening out there. There's a lot more investment that could happen, but is it being targeted at the right areas? And one of the things that we were discussing is a lot of it seems to be geared towards mitigation. How much has that actually been channeled into adaptation, which, if you listen to the IPCC and lots of others, is also something else that we seriously need to consider, especially in some of the developing economies as well. So the question was, how can we, as it were, press the fast-forward button and try and address some of these urgency issues? The fact is, there is no invisible hand, and it really is up to us as individuals, as businesses, and government to get on and tackle the job itself. We actually do need to get everybody else mobilized. Everybody needs to get on board to tackle this one. Sort of a phrase I often use, probably overused, but sustainability is not a spectator activity. Everybody needs to be on board. So what are the key issues that we discussed? One of the key ones was the actual incorporation of ESG, the environmental and social and governance issues, into the investment management process. There's a lot more happens within the finance sector, within the insurance sector and the banking sector, microfinance, microinsurance, etc. But this particular session did concentrate on the funds management sector and the incorporating of ESG. So one of the key questions we ask is where should that pressure for change come from? Is it from individuals? Is it from the pension funds? Is it from the investors? Or is it from government? An interesting point is that in terms of motivation for business to change, there are certain variables that need to go along concurrently with any change. And again, without pointing fingers as who's to blame for the current recession and the banking crisis, it's very interesting, as somebody pointed out in our panel, that the rating agencies don't actually take ESG into account in most cases when they're actually assessing the future value of companies. And I think that is one thing that we take away, is that the rating agencies do actually put this onto their agenda. Secondly, in terms of the regulatory environment, I think all, in terms of Basel II, the environment is not part of the capital adequacy calculations or metrics or requirement. Operational risk is taken in there for financial institutions to actually put capital aside, but the environment and social issues are not actually specifically mentioned in the capital requirements. And therefore, I think if we actually take that in, that would be a good one. Okay, just a couple of other points. And I'll just read these as bullet points because they're probably self-evident. Can regulation itself actually lead to innovation rather than an increase in cost? And despite the problem we have with metrics, there's a lot more, as I would call, disclosure on exposure, so that financial institutions can be held account for their indirect exposure as well as their direct exposure. And one of the cautions that was raised was in terms of the urgencies, that we need to be very careful when funds are directed, especially if we get the green packages that are coming through, that the urgency is not sort of marred by the complexity of the problem. There's a great deal of what we call shovel-ready projects out there that if there's too much money thrown at them, they'll probably get, they've been waiting in the wings for years, and we don't actually prioritize the money against the right sort of investments that need to be made. Very quickly, a long discussion on what we called long-term. What's interesting is that we talk in the investment community with pension funds with 20, 30-year liabilities, and yet very few fund managers actually seem to be able to get their clients to talk beyond 2 years. So when we even talk the long-term, there's a great discussion that needs to take place on that. The point was made by one of the panelists that 5 years, if you're looking at an investment for 5 years, it's actually probably termed illiquid. So the whole time horizon needs to be redefined. Okay, I think in terms of from the regulatory side, I think we're all agreed, and certainly the call from our session is that we need a long, loud, and very, very clear policy signals to come through from government, and especially as we lead up to Copenhagen. And another interesting point was that the financial sector needs to reconnect with the real economy. I think that's it. It's a challenge. It's a real challenge, but nobody ever said it was going to be easy. Thank you.